Yes, people, I hope we're all doing well. Welcome back to my trading channel. I hope you've had a amazing start to 2025 in your trading journey. If you haven't, today I have a video for you guys that will hopefully kickstart your trading journey going into this year. Okay, we're still early in the year. There's still a lot of time for you to understand what it is you need to understand. Today, we're going to be speaking about how to correctly identify market structure, okay, and the importance of that. So, I don't want to make this video too long-winded. I kind of want to get to the key points and the key topics and the key elements of the video so that you can take away, take some notes down, guys, and then hopefully go to your own charts and start to see this stuff happening and unfolding live in the flesh. Okay, so that's the only way to really learn is taking notes and then going and seeing, okay, what can I actually see from my own, okay, and training your eyes to see these things for yourself. Okay, so when trading price action. Okay, so I'm a price action trader, day trader. For those that don't know, I don't use indicators. We don't use indicators. You don't need them. The market structure should be the main indicator for you. Okay, and I'm going to show you why it's the main indicator for you. Okay, but when trading price action, it is important to understand trends. Okay, and you need to confirm your bias as well in order to understand what cycle the market is in, okay, what the overall direction the market is going in, and things and such. Okay, so trends, cycles, you're going to hear me use these words a lot if you're a beginner. Okay, you kind of need to get familiar with this terminology and understand that when it comes to market structure, you're confirming your bias on a day to day, if you're especially if you're a day trader, is the most important thing that you're gonna come across. Okay, now, the higher time frame trend, especially, is critical to confirm. Okay, it is critical to understand the higher time frame trend that you're in, so that you're basically not going against the trend when you're, buying when you should be selling and things and such. Okay, so that doesn't mean that you can't be a short term buyer in a bearish market or a short term seller in a bullish market. You can, but that comes with skill. If you're a beginner, don't worry too much about that. I want you to just worry about actually confirming trend and confirming your bias overall, um, as you can understand that, okay, the market direction is showing me this. I should be looking for moves in that direction. Okay, that's the most important thing. So, getting into this, guys, okay, there's three things that I want you to really understand and consider. Okay, and that is going to be these three right here. Okay, the market is either trending, retracing, or consolidating. Okay, so those that don't know what retracing means, it just means that we're pulling back, the market is pulling back. If you don't know what consolidating means, it means ranging or going sideways. So there's no real direction available to us. Okay, trending is obviously going in the intended direction of the trend, but you do get signs and spells of retracement and consolidation where you may not have a clear, concise bias. So it's really important to understand these three things so that you're not getting mixed up when you're saying, okay, am I bullish? Am I bearish? Am I pulling back? Or am I reversing? Or, a reversal is very different from a retracement. It's not the same thing. Okay, a reversal is the trend is actually changing overall. That's what a reversal is. But a retracement is necessary to actually continue the trending direction. Okay, so before we get into the charts of actually showing these things, I just want to give you some illustration. So what you should be seeing in certain cycles. Okay, so if we are in what is known as a bullish cycle, where the market is trending upwards or an uptrend, whatever your familiar term you're familiar with, these are the concepts. You should be getting a low to begin with, and then we move to a higher point in the market, and then we get a higher low point and a higher high. Okay, that is bullish price action. Okay, higher lows, higher highs, higher lows, higher highs. As long as you're continuing getting higher lows and higher highs made, then the market is bullish overall. But one thing I want you guys to consider is when we make a higher high and then we're making a higher low at some point, okay, when the market is coming down as it does here, okay, that is a retracement, right? That is a retracement. So a lot of people, when they're getting started, they can actually consider this or think of this as a reversal. This is not a reversal. Okay, this is not a reversal. In order to get a higher low, the market has to come down. It has to pull back. Okay, so a lot of people, they get, these terms misconstrued, or they think, oh, okay, the market's now it's now a seller's market and things and such. To an extent, yes, you can be a seller in this retracement phase, but only up to a certain point, because as long as your bias is still overall looking to go higher, this isn't basically going to drop through the floor. Okay. And the structure points and the market structure confirms this. And when we get into the charts, I'm going to show you how to confirm it. But what you have to be ready and willing to understand is the market will pull back, okay, in order to form a higher low and then continue the trend higher. Okay. So this is going to be the trending part of the bullish cycle. And this is going to be the retracement part of the bullish cycle. Okay. Now, if we are in a bearish cycle and we're in a bearish trend, okay, we should be getting a high made, a low made, a lower high, a lower low, a lower high, a lower low, lower high, and a continuation in that fashion. Okay. So if you're experiencing bearish price action, that is what should be printing. So it's really key that you understand structure points from the perspective of what should be happening. If I've identified the trend to be bullish or bearish, what should you be getting? What should actually be printing? So that you're not confused when these things are happening and you're now second guessing or maybe thinking to yourself, has the trend changed? You should be able to confirm with the market structure if the trend has changed. And how you do that is by understanding where the structure points are. So if we now have printed a lower low, we should be anticipating a lower high. It shouldn't come as a surprise that the market is now going up. Okay. If we've now got a new lower low made, we should be expecting at some point a lower high to be made. Now, there's no timeline, should we say, or timetable or schedule for when a lower high should be made or when a new lower low should be made, and vice versa for bullish price action. We don't know when a higher high is going to be made. We don't know when a higher low is going to be made. But all we can look to speculate on is, I know the trend is in that direction. I want to see a continuation in that direction. So when a lower low is made and you know a lower high at some point is going to be printed, we can potentially look for reasons to now buy the retracement. Yeah, because we don't want to always wait for when it's trending lower. Okay. When you're in the beginner phase, it's a good practice to follow. But as you start to gain your experience, you're going to be selling and buying and selling. It doesn't matter in regards to the trend overall. If you understand how to read where you are, you know where the opportunity is. If it's a short-term one because you're not in the actual overall trend direction, this is a short-term buy. Okay. And there's nothing wrong with that. You don't want to just be waiting for the move to kind of continue the trend, because that we don't know how long that's going to take. We don't know how long it's going to take to get a lower high made. Okay. So that's what bearish price action should look like. Excuse me, that is what bullish price action should look like. Okay, very, very key understanding for those that are trying to identify trends. Okay, because that's how you spot cycles and what you're actually expecting. Now, consolidating markets, okay, is just no direction. It's going nowhere. It's going up, it's going down, it's going up, it's going down. Now, in my opinion, these are times where you should actually avoid trading. Okay. Or if you are going to trade, it should be very, very short term trades. Because if you've got no real direction, it's just you're gonna get frustrated. You're gonna get into a buy, you're in profit a little bit, and then it comes back down to entry. Maybe you're at break even, it taps you out and whatnot, and then you got to continue trying to find moves in that cycle. Okay, when the market is consolidating, right, all it's doing is building orders. Okay, the market can't trend forever, and you shouldn't expect it to trend forever. Sometimes it needs to build orders. Okay, so if people are buying and selling, what we have to understand here and here is that we're going to see people have stop losses above, stop losses below. Okay, so when it's buying and selling and doing stuff like that, you don't necessarily want to be involved in that. Okay, because again, you don't know which way it's going to target first because it's consolidating. It might go for the low first, it might go for the high first, depending on which direction you're in. It's really you're kind of entering the territory of guesswork. And we don't want to do guesswork. We want to kind of understand where we are within the trend. If it's consolidating, fine. Not every day you need to be in a trade. Okay, a lot of misconception about trading is that there's a trade every day. That's not necessarily true. I don't believe that's true, and you shouldn't even look to trade every day. Okay, so a consolidating market, ranging market is when it is going sideways. It's not a clear indicator as to what the next move is. Okay, so if it's not clear, then it's harder to engage. I'm not saying you can't engage in this market, it's harder to engage. So those are the three things that we kind of need to understand in terms of the pictures that we're in. Okay, if we move towards the actual price action now itself, okay, another thing I want you guys to understand as well, guys, is don't focus too far back on price action. Okay, we're in 2025. We shouldn't be, that pissed off regarding, excuse me, we shouldn't be that pissed off regarding what the market was doing in 2019, what the market was doing in 2020. We shouldn't be pissed off about stuff like that. Okay, meaning that when it comes to understanding the trend, what was happening in 2019, it's not relevant to now. We're 6 years into that time period. 2020, COVID times, or 2021, when things was kind of kickstarting and the markets was getting back into reversal trends and stuff like that. We shouldn't be focused on those periods of time. We're in 2025. In my opinion, you should only really look at price action a year and a half, 2 years max is what you should be looking from a timetable of trend and understanding cycles and what has happened and what hasn't happened. 4 years ago, 5 years ago is not as relevant as right now. Okay, so when we are on the monthly time frame, okay, and we're clearly, if we look at the price action, we can clearly see this is GBP USD. We can clearly see we're in a downtrend. Okay, the market is clearly heading lower on the monthly. So overall, it is still in a downtrend. But look at where the cycle of how long it really took to start getting down. You're talking, 2014, 2016. This is 2018. It went here in 2019. Back in 2021, it got back to here. And then 2022, it hit down here. Think about how long of a time period that is. So it's all good like drawing from a structure perspective, lower high, lower low, lower high, then you had another range bound. You could really call this a range in terms of this price action right here. If you think about it, this is kind of sideways price action. Yes, it's made a lower high, it's bounced down, it's come back here, and then it's bounced down again. All of this is a range. So if you think about 2016 to 2020 or even to 2021, think it's 5 years. It's been kind of going up and down on the monthly time frame. But that doesn't mean on the daily time frame and the weekly time frame we can't catch moves. Of course we can. So that's why I'm saying don't think too far back. It's important to understand the cycle overall you're in, yes, but in terms of actually figuring out, okay, what I want to do from 2024's price action, 2023's price action, that's more important, that's more imperative. Okay, so having one eye on the bigger time frame is cool. I'm not saying don't do that, but I'm just saying overall, you're not really going to be trading and taking entries from a monthly time frame. You're just not really going to do that. Okay, so when we go into the weekly time frame, right, we can kind of see overall like what the price action is doing. Yes, we are heading higher on a weekly time frame, but if you think about the structure points, and that's what I want you guys to focus on, is that there's things that we can see as evidence to suggest why we should be continuing in an uptrend or why we should be retracing and coming down. So based off of what I've said, off of price action moving higher, okay, pulling down here, okay, and there's something I want to touch regarding shallow retracements. Okay, there's a such thing as a shallow retracement and a proper retracement. Shallow retracements, right, we don't actually factor them in regards to market structure overall. And the reason for that is when you get a shallow retracement, it's normally an area where liquidity is being built. Okay. And at some point in the future, you're likely to see that shallow retracement taken out. And I will touch on that in a little while, but I just want us to understand that when we get pullbacks like this, on a smaller, so like on the weekly time frame right here, okay, for some weeks we was heading down lower. On the daily time frame, that's going to look like a lot more price action. Okay, but overall, if we think about the structure points, this is where we're at. Point here, point here, point here, point here, and now we're heading down low. Okay, so think about the structure from these points here, okay, in terms of it being shallow. Now, in my opinion, on GBP USD, I don't think we've actually had a proper retracement for us to now get the next leg higher. I think we might come down a bit more to then get the next leg higher. I can see that based off of just what the structure is showing me. So even if you look at what price action is doing here, okay, let me just put a box on it like this, okay. The top of the range was here, the bottom of the range was here, then we was kind of floating. Now we've taken out the top of the range and now we're surrounded towards the bottom of the range. We're likely to take the bottom of this range out, okay. So just understanding again, we're either trending, retracing, or consolidating. If the market is going sideways, you need to be able to identify that. And the market structure will show you it is going sideways if you take a neutral stance, right? If you take your bias goggles off and you look at it neutrally, what is the market doing? Okay. When we've pushed to this point here and we've retraced, we've pulled up here, we've retraced, we pulled up here. All of this price action, realistically, if we just go from here to here, is still in a range. We haven't broken made a new higher high yet. Okay. And this low point of the range is still intact. So if you're thinking about July 2023 to August 2024, this is a year of ranging price action. Okay. But you're still going to get moves available to you within that time frame and that period of time, right? You don't have to just sit on the sidelines and be like, it's not doing much. We're not taking entries off of these time frames, but we're just looking where we are within the structure. That's all we're doing. We want to know where we are within the structure. Okay. So the daily time frame, guys, is key. It's one of the most key time frames that you're ever going to come across. Okay. Especially if you're a day trader, the daily time frame is everything to you. Right now, the reason being is everything to you is because you're going to get and position yourself in areas mainly based off the daily time frame, sometimes the 4 hour time frame as well. And from a structural perspective, you just get a lot more information, okay, that in terms of structure points and things like that, where I understand where I am on this time frame. Okay, when you understand where you are on the daily time frame, you know what going into a new week, what cycle the market is likely to deliver in terms of direction. Yeah. So again, key points here, we've got a higher low here. Okay. If you look at when it makes a higher high here, this is another shallow retracement. Okay. It's shallow. It's very, very shallow. So when it comes to identifying shallow retracements, we don't factor them in as, okay, this is a higher low point, right? Because it's not a higher low point, it's a shallow retracement. There's a very, very big difference between a proper retracement. And if we just go back quick, let me just zoom into the weekly. Hold on. If we go back, right, I want you to understand, like, look how deep of a retracement we should be getting. If I was to draw something like this and it went like this and then it continued up, it's very difficult to say this is the same as that. It's really not. Okay. And there's other YouTube videos I'm going to do that will go into a more depth of why we don't include this as a proper retracement and why this is a proper retracement. Meaning, if you think about premium price zones and discount price zones, that's what that's about. But I want to kind of stay on track with this. And if we go back to the daily, right? A lot of people, if they include this as a higher low, and then we go up and make a higher high, and then we make a higher low, a lot of people would think this market's reversing and it's changing structure, and a break of structures occurred and stuff like that. That's not true. Okay. So when it comes to identifying proper retracements, just look, how deep did it really go? Okay. If you think about it, right, this price action here itself, it kind of went sideways. It went to the top of a range and then it went to the bottom of the range and then continued higher. But that's not really a retracement. Okay. So understanding what is happening from a real retracement or a deeper retracement to a shallow one makes you understand that really the market hasn't done that. It's done this to here, and then it's done that. Look at the difference in size from this to what we got here. It's very, very different. Okay, and that's something that took me a while to understand so that I wasn't making mistakes in putting every pullback or every little maneuver that went against the trend as a retracement or considered it as that. Because once you do that, guys, I'm telling you, it confuses you. Because then when this happens, you then think it's a break of structure. I'm now looking for a reversal up here to pull back here to then go down. And that's not what the market does. Okay? Because if you read the price action wrong, okay, you're on your way to failing. I'm not gonna lie. You're on your way to failing. Okay. So reading the difference between a shallow retracement and a real retracement is half of the battle in correctly identifying market structure. Okay, it's half the battle. If you can understand the difference between shallow and proper retracements, a lot of people, they just say, oh yeah, they draw the structure however they want to draw the structure. Okay, think of it like this. Before I continue, when we was coming down, right, when we're going into that bearish price action, we can see, okay, we're making lower lows, we're pulling up, we're making lower lows. If we then look at what price does here, from this lower high point to lower low, if we then see it go here and then we pull down and then it goes here and then we pull down, people are adding sells thinking, okay, as long as we don't break past that point where we should be heading lower, okay? But once that does not happen, okay, that's when you identify, okay, the structure is definitely broken. It's definitely doing something different. Okay, so if a breaker structure has occurred, you have to now change your bias. Your trend overall is now changing. Okay, on the time frame that the structure breaks. Okay, so if it breaks on the daily, you see a daily structure break, that's still a higher time frame. You need to consider, okay, I shouldn't be looking for sales now. I should still be looking for buyers now, right? I should start thinking about buying. But when you start factoring in shallow retracements, right, and we go over here now, if you factor this in here and then you think the same thing occurs, right, which it does when it breaks past this point here, you're now thinking, okay, it's bearish again. But that's not true. That isn't true. It's just giving you a proper retracement. Higher low. Okay, let's just go through the points. Okay, you got a low, the trend changes here, so this makes what's it called, the high. We then get another high. We haven't really got a higher low yet. Okay, we then go into a consolidation here. We take out the bottom of the range. Okay, so we're grabbing liquidity, we're grabbing orders. We then get a new high made here. We get another shallow retracement here, and then we get a new high made here. Then we get a higher low made. Okay, so it's a lot to fathom, right? Especially when you're trying to really understand market structure, but you need to understand it that way. So that way you're not trying to change your bias or incorrectly change your bias and change the trend when it's not actually changing. So then moving forward, okay, higher high is here, higher low is here. As long as we're bullish, you're expecting price to go above that higher high now. Okay, that is what you should be expecting. So you're trying to position yourself as best as you can, right? This is not a higher low. Why is this not a higher low? Because if this is a higher low when we haven't gone past a higher high, this is not a higher low. So it's very imperative you understand that on a smaller time frame, so on a 4-hour time frame, this is its own structure. This is a different structure. It's not a daily structure. So you have to understand the market structure points on each time frame so that you're not confused. Okay, so then we get a new higher high right here. Okay, we've got a new higher high right here. So once we start seeing price action falter down, we now have to consider, okay, why has it come down so much? And then you have to then revert back to, okay, where are we at on the bigger time frame? Because when you understand where you're at on the bigger time frame, all your drawings and your markings are now going to come into fruition of, okay, I understand. So key takeaways, guys, that I want you to think about with what I'm just telling you guys is breaker structures are very important to identify, but you have to identify them correctly. That same shallow retracement here, where it goes up and then it comes down, a lot of people say, okay, the structure's broken. They then wait for a pullback and then they're thinking the market's going to sink. And they're looking at it wrong, okay? And that's something that if you do get wrong, you're in a world of trouble. because you're going against what the trend is actually doing. Okay, so thinking about drawing structure correctly, okay, this is where we're at with it. Okay, and then when we do this here, okay, I want you to think about that point so far, right? And then we've pulled up here now. Okay, so let's go on a monthly time frame. Okay, and I want you to just think about those same drawings, right? In terms of what I'm saying about the retracement. The bigger the time frame, you start realizing that these retracements aren't really that big. Yeah, so when you understand the context of identifying trend and identifying bias, it's relevant to the time frame that you're drawing the, making these markings on. Okay, because if you look at the wider perspective of, okay, this was the last lower high point we got on the monthly time frame, then we tanked, we made a new lower low. This could be potential lower high point to then come lower again, right? But when you're on the daily and the weekly time frame, those same areas, we are pushing up to make this picture on the monthly time frame. Okay, so it's imperative that you find the relevance for each of your drawings on the time frames that it makes sense on. Okay, if you get what I mean. So that's kind of what I want to give you guys for this session. I hope you had some notes on it, and set yourself a task. Go into the market yourself and think about whatever pairs you trade. Market price action is all the same. It doesn't really matter. Go into the charts yourself and see what you can see. Set yourself a task of identifying, okay, what trend or what cycle is the market currently in? How can I confirm and identify that, okay, this is the market cycle I'm in? It's important that you do that, guys, especially if you're going to be trading on a day-to-day, week-to-week basis, okay? So if you found this video useful, obviously, you have any questions, please leave them in the comments and I will get back to you. Thank you for watching the latest episode. If you like that, please like and subscribe to my YouTube channel for more content. I'll see you on the next video.